Welcome to Have You Read It, the channel where we bring books to life, one summary at a time. Today, we're diving deep into John C. Bogle's The Little Book of Common Sense Investing, a surprisingly insightful and concise guide to navigating the often bewildering world of finance. This book isn't about flashy strategies or get-rich-quick schemes. It's about the foundational principles of sound investing. Principles so simple they're often overlooked in the pursuit of market-beating returns. Get ready for a journey into the world of index funds, cost minimization, and the relentless rules of humble arithmetic. Bogle, the founder of Vanguard, starts by telling a parable of the Gotrox family. This family initially owns 100% of every stock in the United States, reaping all the rewards of business growth and dividends. Their harmony is disrupted when helpers, brokers, money managers, and consultants arrive, convincing some family members they can outperform the market through active trading and stock picking. The result? The family's overall wealth growth slows down dramatically, as the helpers take their cut in fees and commissions. This parable illustrates the core conflict of interest in the investment industry. Those who manage money benefit from constant activity, while investors as a whole benefit from minimizing costs and maximizing long-term returns. The moral? Don't do something, just stand there. A simple yet powerful message that often gets lost in the complexity of the modern financial market. The Gotrox family's ultimate success came from returning to their original passive strategy of simply owning all the stocks, mirroring the essence of index fund investing. Warren Buffett, quoted extensively in the book, adds his own Newton-like fourth law of motion. For investors as a whole, returns decrease as motion increases. The book then explores the relationship between business fundamentals and market expectations. Bogle meticulously demonstrates the strong correlation between long-term business returns dividends plus earnings growth and long-term stock market returns. He breaks down returns into two components: investment return driven by business fundamentals and speculative return driven by changing investor sentiment and valuations reflected in the P/E ratio. While speculative returns can lead to short-term market volatility, the long-term trend is largely dictated by investment returns. This distinction is crucial, as it highlights the importance of focusing on the underlying economics of investing, rather than getting caught up in the short-term noise of market fluctuations. Benjamin Graham, a legendary investor, is quoted, emphasizing that, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. This means that short-term price movements are often driven by emotion, while long-term valuations reflect the underlying value of businesses. Building on this foundation, Bogle advocates for a simple, elegant solution: investing in a broadly diversified index fund. This strategy, he argues, aligns with Occam's razor, the principle of choosing the simplest solution, by providing the most straightforward way to own a piece of all businesses in the market. He compares the Standard & Poor's 500 S&P 500 and the Dow Jones Wilshire Total Stock Market Index, highlighting their remarkable similarity in returns over time. The key takeaway here is that consistent long-term returns outweigh short-term excitement. The book points out the flaws in chasing short-term performance or relying solely on star ratings from services like Morningstar, emphasizing that past performance is not a guarantee of future results. Bogle illustrates this point with examples of top-performing funds that dramatically underperformed in subsequent years, showcasing the impact of reversion to the mean. A significant portion of the book focuses on the devastating impact of costs on investment returns. Bogle emphasizes the relentless rules of humble arithmetic, showing how fees, commissions, sales loads, and turnover costs compound over time, significantly reducing overall returns for investors. He presents compelling data demonstrating how the average mutual fund investor consistently underperforms the market, largely due to these excessive costs. The author provides illustrative examples to highlight the staggering difference in accumulated wealth between a low-cost index fund and the average actively managed fund over a 50-year period. This demonstrates the tyranny of compounding costs, showcasing how seemingly small fees can dramatically impact long-term returns. The importance of considering taxes as a cost is also stressed, highlighting the tax inefficiency of many actively managed funds due to high portfolio turnover. Index funds, with their buy-and-hold strategy, generally have a significant tax advantage over actively managed funds. The book then examines the challenges of selecting superior fund managers. Bogle presents data showing the difficulty of consistently identifying long-term winners, with the vast majority of funds either underperforming the market or failing altogether. He highlights the impact of size and fund growth on performance, showing how successful funds often lose their edge as they attract large inflows of capital. He cautions against chasing past performance, emphasizing the role of randomness and luck in short-term investment success. The book also explores the effectiveness of seeking professional advice for fund selection. While acknowledging the value of financial advisors in providing comprehensive financial planning services, Bogle presents evidence suggesting that their fund selection abilities often do not significantly outperform the market average. Studies cited show that funds recommended by advisors may cost investors billions of dollars annually due to higher fees and underperformance. Bogle emphasizes the importance of focusing on the lowest cost funds, arguing that cost is the most consistent predictor of long-term performance. He demonstrates the strong correlation between lower expense ratios and higher returns across various fund categories and styles. This emphasizes the power of minimizing expenses to enhance long-term returns. The book goes on to present a strong case for index funds that track the entire stock market, highlighting their ability to consistently outperform actively managed funds over the long term. The author emphasizes the majesty of simplicity and the importance of minimizing costs. The book details the success of the S&P 500 index fund, comparing its returns to those of actively managed funds and illustrating the significant accumulated wealth advantage over time. The power of compounding is emphasized, illustrating how small annual differences in returns result in massive differences in accumulated wealth over the long run. Bogle then explores the potential impact of lower future stock market returns on investment strategies. He argues that the high returns of the past 2 decades were partly due to unusually high speculative returns, and that future returns are likely to be more modest. He presents projections for future returns, emphasizing the increased importance of cost control in a lower return environment. In this lower return scenario, the cost advantages of index funds become even more pronounced. This highlights the importance of a long-term perspective and the need for a strategy that is resilient to market fluctuations. The book also discusses the emergence of exchange-traded funds ETFs, a newer form of index investing. While acknowledging the advantages of ETFs in terms of intraday trading and potentially lower costs, Bogle cautions against their use as trading vehicles, emphasizing that frequent trading negates the long-term benefits of index investing. He highlights the risks of performance chasing and the potential for higher costs and taxes associated with ETF trading. The core argument is that the ETF's design, which enables easy and frequent trading, often undermines the core principles of buy-and-hold long-term investing. Bogle considers the views of Benjamin Graham, a renowned value investor, concluding that Graham would likely have embraced index funds. He highlights Graham's emphasis on diversification, long-term investing, and the limitations of actively managing money. This adds historical weight to the book's central theme of simple, low-cost investing. Warren Buffett's endorsement of index funds, referencing Graham's own support, further strengthens this point. The conclusion highlights the harmony between Graham's investment philosophy and the principles of index fund investing. The book concludes by outlining a practical investment strategy, emphasizing the importance of separating investments into funny money and serious money accounts. The funny money account can be used for speculative investments that might provide excitement and learning opportunities. The serious money account, on the other hand, is reserved for core investments, primarily in index funds, to ensure long-term financial security and wealth accumulation. The author offers various alternative strategies for supplementing index funds, such as international diversification and sector-specific funds, but always with a strong emphasis on cost minimization and long-term investing. He urges readers to avoid chasing performance or overcomplicating their investment strategies, emphasizing the importance of a disciplined approach and a clear understanding of the basic principles of investing. So, what are the key takeaways from The Little Book of Common Sense Investing? The importance of low costs. Bogle repeatedly demonstrates how seemingly small costs can dramatically reduce long-term investment returns. The relentless rules of humble arithmetic underscore the need to prioritize low-cost index funds. The futility of market timing and fund selection. The book provides substantial evidence to show that consistently outperforming the market is extremely difficult, if not impossible, for most investors and advisors. The book highlights the impact of emotion and the role of randomness in investment outcomes. The power of diversification. Bogle strongly advocates for broad diversification to mitigate risk. Index funds, by their nature, provide the broadest possible diversification, eliminating individual stock risk, style risk, and manager risk. The importance of a long-term perspective. The book emphasizes the importance of a long-term investment horizon to capitalize on the power of compounding and to weather short-term market fluctuations. Simplicity is key. Bogle argues that a simple, low-cost investment strategy is the most effective approach for the majority of investors. The classic index fund represents this approach, requiring minimal effort and decision-making while maximizing long-term returns. Some easy-to-remember heuristics from the book include, don't do something, just stand there. This emphasizes the benefit of a passive, buy-and-hold strategy. The market is a weighing machine, not a voting machine. This highlights the importance of focusing on the underlying value of businesses rather than short-term market sentiment. Don't look for the needle in the haystack, just buy the haystack. This suggests buying a broadly diversified index fund instead of trying to pick individual winners. The two greatest enemies of the equity investor are expenses and emotions. This concisely summarizes the importance of cost minimization and emotional control in investment success. The more the managers take, the less the investors make. This simple statement underscores the direct relationship between fund costs and investor returns. In essence, The Little Book of Common Sense Investing is a powerful reminder that successful investing is not about complex strategies or market timing expertise. It's about understanding the fundamental principles of investing, minimizing costs, and embracing the power of simplicity. By focusing on these core elements, investors can significantly improve their chances of achieving their financial goals. The book's persistent emphasis on low-cost index funds, coupled with its warning against emotional investment decisions, provides a clear path to successful long-term wealth creation. Thanks for watching. Make sure to give this video a thumbs up and hit that subscribe button so you never miss our next book dive.